Hey folks, welcome to Snowpal podcast. Our guest today is Dr. Adam Link. Dr. Link is the founder of Fireweed Capital. Link, thanks for taking the time to chat.
Yeah, it's great to be here. Thanks for having me.
Before we get started, if you could just give a brief introduction about yourself and what you do, and then we can jump into the top.
Yeah, certainly. So I'm here primarily wearing my hat as a wealth manager today. I do financial planning for folks who have, I would say, complicated income situations, typically software professionals. So folks that have, a base compensation plus RSUs or ISOs. And then I've been doing wealth management basically for a number of years now, about 3 years. Got into wealth management because I was a software engineer before that. So I also have about a decade of software engineering experience, all the way from individual contributor up to a senior engineering manager as well. So we'll kind of toggle between the hats today. We'll mostly focus on the wealth management side, but I've got a decade of experience as a back-end engineer too.
Thank you for that introduction. So I think a good place to start, or at least not a bad place to start, is my first question would be I've seen a variety of different career paths when it comes to engineers. I've been a developer all my life and I run a startup now in the suburbs of Washington, D.C. But engineering to wealth management, I've got to say this is my first experience, right? So can you help us sort of understand what was the transition? I mean, is that a natural progression that I'm just not aware of, or is it something that you were interested in? And you're like, you know what, doesn't matter if it's related or not, I'm just going to do it.
Yeah, it's a great question. So I will say I got my bachelor's in finance. So I started out a little bit in the financial realm, and ended up actually transitioning into technology when I built my first startup and sold it. And that really got me into the technology world full time. And so then, I went on, got my master's in computer science, my doctorate in computer science as well. But along the way, I never really lost my passion for finance. And the way that this usually manifested itself was I ended up being the person who talked about, the benefits a company offered, or, here's what I'm doing with my allocations in a 401k. What are you doing? And I basically got to the point where I was financially advising people without calling it financial advising or getting paid for it. And the thing that tipped me over the edge was I gave a presentation to a real estate investment group for one of the companies I worked at, and started talking about management of syndications and securitization and equity issuance and all that. And I just watched as all these engineers just had like blank stares in their faces. And I was like, okay, let's take a step back here. Do you guys know what equity is? And everyone's like, no, no, no. I have one rental property. I'm like, okay, I went off the deep end here talking about how to buy a 500 unit apartment complex.
Right.
And I decided, okay, at this point, obviously there's a need in the financial world. Obviously, I know a little bit about finance, and obviously I'm an engineer as well. So I said, you know what? I should get paid for doing all this. So I went out, I got my license, Series 65 license. So now I can get paid to talk about finance to engineers. So that was my path. It's not a normal path. It's not like every engineer suddenly ends up in wealth management.
No, that's fair enough. It's actually an appropriate time to even have this conversation because one of the next things we are starting to work on at Snowpal, Dr. Link, is a fintech API, right? We have a few products. One of it is an API product that we publish on AWS Marketplace. So we have several APIs, and the next one we're actually starting to work on is fintech. And in the last several months, me and some other members of my team have been actively sort of been in the stock market, trying to understand the pain points so we could build something that actually is able to alleviate those pain points, right? So it's not trying to find manufactured problems, but real problems. So I think I'm very excited of having this conversation here. So the topic that I asked you, that you had loosely picked the title before we hit record, was common mistakes engineers make in their finances. And I think you sort of gave an intro to that already, meaning you gave this presentation and then you saw that the engineers or developers had a blank look on their faces because they did not necessarily understand those terminologies. So common mistakes engineers make in their finances. Let's start there. What are some of them that you've seen?
Yeah, let's start out with probably the most common mistake I see engineers make in their finances. And this is over optimization, right? We're software engineers. We know ways to optimize systems. Most folks who are doing interviews at large tech firms are doing some sort of a coding exercise to even get a job. So whether it's, a sorting algorithm or some sort of, depth first, breadth first search, we know our algorithms. The problem with investing is not algorithmically based. And I know everyone out there who does trading is going to say, well, that's a false statement. And okay, yes, there are some algorithms. But at the end of the day, you can't optimize a system like the stock market in the same way that you can optimize, say, a large application serving millions of users. And so what I see engineers end up doing is they will try to optimize around the things they can control, right? How much money they're putting in, how much money they're being charged. And what they end up missing is the fact that the true optimization you should be looking at is your actual behavior and not any numbers. So that's like the first thing that I see engineers get tripped up on. And then past that, we can go talk about just kind of the free money that I see engineers leaving
But
on the
what would
ground.
be so for that first point you just mentioned there, right, where investments are not necessarily, at least not in all cases, algorithmic, and the fact that engineers tend to optimize their investments. What's a good example? We can sort of even manufacture an example here or take a real life example of somebody that's an engineer and who's investing, and what have you seen them typically do, and then it raises like red flags to you.
Yeah. The one that I love is the engineer that saves money on fees. They've gone and they've invested in a large passive investing strategy. I'll call out Vanguard. I happen to like Vanguard as a company, but they're also one of the leaders in the passive investing space. And so you'll have an engineer that is very proud that they're paying 0.03%, and they've bought the entire stock market, and that is their plan, right? They're going to invest on that. They have optimized their fees down to next to zero. Now, I've been alive long enough that I remember '08. I remember some of the cyclicality that the markets throw at us. And what happens is you will end up paying 0.03% in fees for all the years that the market is going up. And you feel like a genius because you are getting all the upside in the market. And then one year the market does a 20% drawdown or a 30% drawdown. And invariably, every or most engineers will freak out about month 2 of the drawdown and go to cash to save what money they have. And they have saved all this money on fees and then sold it at 20% loss. And effectively now, again, because we optimize things, you've just broken your entire optimization algorithm with one human behavior.
But Dr. Link, why is this specific to engineers though, right? To me, what about engineers makes this statement specific to them as opposed to just anybody who's investing in the stock market?
Yeah, what I found with engineers is there's a particular fee sensitivity and a desire to dig into what is actually in your portfolio. Engineers generally, and this is what the financial industry tells us, and I've seen this myself, engineers generally ask a lot more detailed questions rather than just taking everything at face value. And so a lot of times when you're talking with a financial advisor, right, they're going to say, oh, well, my fee is 1%. And an engineer will say, great, what am I getting for that 1% versus the 0.03% that Vanguard will charge me. And a lot of financial advisors at that point really struggle to represent what it is that they do that is different than Vanguard. And a lot of financial advisors, frankly, are also just buying Vanguard and charging you 1% instead of 0.03%. And so the engineer goes, well, if I can do the exact same thing you're doing, I'm just going to buy the cheapest thing. And so a lot of engineers I see generally try to do it yourself by buying the cheapest possible funds, right? And I think that's a unique engineer optimization that we do that other people I have not seen the general public do that level of comparison against fees in particular.
Oh, okay, interesting. And then, given that as a limitation, what is your general recommendation as to how they should actually be doing it versus how they are generally doing it right now?
Yeah. So I will say a lot of the financial industry may disagree with me on this point, but my view is that active management is actually better than passive management. There's a lot of academic studies out there that actually do point to the fact that active management can outperform passive management in many scenarios because of one critical distinction, and that is the drawdown protection. So when you look at the fact, again, Vanguard, you're paying very little, but you're exposed to both the upside and the downside. And it's that loss that triggers the human emotion. And this is where every software engineer behaves like every other human, right? We try to optimize all that we can, But when your portfolio is down 20%, okay, and 20% is an abstract number. Let's say you've got $1 million in your portfolio and you wake up one morning and you're down $200,000. That's a big number. $200,000 in the red makes most people worry about their portfolio. Engineers are no different. And so the pressure and the desire to say, when will the bleeding stop, right? And then you sell at the bottom. That's the trap that you fall into with that passive indexing.
Okay.
Whereas active management, and this is the philosophy I have, active management says, well, look, if we can start to see signs in the market that suggest there might be turbulence ahead, let's start taking a defensive position so we don't wake up and see a $200,000 loss in our portfolio, right? We might see a much smaller loss, $10,000, $20,000. And that alleviates that knee-jerk reaction to sell at the bottom.
Okay, so I have a number of questions there, right?
Let's
It's
do
a
it.
very interesting topic. Okay. And I'm going to make some assumptions along the way and correct me where I'm wrong, Dr. Lenko, right? So the first thing is active versus passive management is what you had said. So for somebody like me who does not necessarily understand the terminologies, I'm going to make an assumption and tell you what I think it is, and you can tell me if I got it right, wrong, or I'm completely off there. So passive management is where you're probably investing in mutual funds or index funds and ETFs, whether it's Vanguard or Fidelity, when you're investing through your company, whether it's fund Ks or IRAs, you have a number of these options depending on whether you want aggressive or moderate growth, or there's like hundreds of them, right? So you pick one or more of them, allocate your investments, have percentages going to one or more of those funds, and then you're done. Maybe you wake up like a bear every 6 months to just check on what's happening, but you're not keeping a close eye on it. Versus active management, where you're probably either doing it yourself or working with a financial advisor, but keeping a closer tab on everything that's happening, even if not on a daily basis or a weekly basis, perhaps on a more frequent basis than the passive investor might have been. And again, I've completely come up with a creative set of definitions for these two terms. Tell me if I got it right, wrong, where am I?
Yeah, that's pretty much exactly the difference, right? Passive index investing is looking at the broad market and saying, I don't know what's going to happen. I don't know what company is going to win or lose. And so, in the absence of any knowledge, I will buy as broad of the market as I can for as cheap as possible and hold it all. And active management says, I think I can understand what's going to happen in the market before it does. Maybe not perfectly, maybe not an individual stock, but I can look at certain indicators and say, academically, historically, these indicators have meant a recession is coming up, or we're about to enter a growth cycle. And based on that information, I'm going to take a view and a position in the market that allows me to profit from that, right? So that's basically active versus passive management in a nutshell. And you're right, you do, when you're doing active management, have to watch the market. You have to look at economic reports. You have to be more engaged than someone who is just passively investing.
Okay. I'm going to say that I'm going to take the engineer out of the picture here for a second, because the way I see it is that everything that we've talked about thus far, and probably what we're going to talk about for the next half hour as well, is, I would say, maybe specific to the individual's personality, at least in my opinion, Dr. Link, more than their role, right? Whether you're an engineer, whether you're a finance person, or maybe, I don't know, you're running a food business, it does not matter. Maybe there's other facets of your personal and professional lives that might make you go towards one or the other, right? A lot of people I know are passive investors, so to speak. And if not for any other reason, the one reason I can think of is, at least I can think of two reasons why they might resort to doing that. One is they simply do not have the time to watch the market and see what's going on. That's as simple as that. And two, even if they did have some time, probably they don't feel confident enough understanding what's happening, right? That could be two reasons. And if those are reasonable reasons, that those would be applicable to an engineer as much as it is to a non-engineer as well, right? So it's just individuals per se. But the couple of questions I have as a follow-up to that is, you took an example of a 20% correction, right? I'm going to make our lives a little bit harder than that, because a 20% correction is an interesting number, but that's not something you're going to see frequently, right? In the last 10 years of what's happening, I don't know how many times we've seen actually a 20% correction. So we're talking more, let's say we go with the S&P, I don't know what the average is, maybe 10, 11%. This year it's probably been a little bit higher. So if somebody had $1 million in the portfolio,
Mhm.
what is the likelihood that they're waking up to a 10% fluctuation? If they had diversified their investments, that's very unlikely as a number, isn't it?
Yeah. So we'll start with what is the probability of seeing a 20% correction? And in the last decade, we have seen at least two 20% corrections. And I'm just recalling a chart in my head here. I can get you the actual stat on what that is. Again, being an engineer, it's like, well,
Sure.
there's an exact number.
Right.
But no, at least two. And typically we usually see a drawdown anywhere between 20+% every 3 to 4 years. And so you're right. It's not like it's happening every month. But what we're trying to protect against with active management is that one day that happens every 3 years. And that's the day that it matters. So how often are you going to wake up and see you've lost 20% or $200,000 in $1 million portfolio? Very rarely. What you typically see, and this is the nefarious part in human behavior, is you wake up and you're at 1 million. And a week goes by and there's some bad news. Country A is invaded country B, stock market reacts poorly. You go check your portfolio, you're down $50,000, right? The next week, country B is now going to be in a recession as a result of this, right? A region of the globe has turmoil, down another 50,000, right? And so what happens is a series of paper cuts on the way down that you just start getting worn down, right? And the idea of I'm not going to sell, I'm not going to sell, I'm not going to sell is really what's keeping your portfolio afloat. But over the course of a number of weeks, you get worn down with negative news until eventually you look at a graph that shows, oh, well, I'm down 20% in the last month. And that's when it starts to sink in. That's when the human behavior takes over. And you start thinking, there's a voice in the back of your mind that says, is this going to continue? Am I going to be down 25% next week, right? Am I going to be down 30% next month? What if I just sold what I have? And that's that nagging voice in the back of your mind with passive investing that the minute you answer that with, I agree, I'll sell, that's when you've locked in that 20% loss. Almost, it doesn't matter how much you would have paid in fees for those 3 years leading up to that, because you've wiped out most, if not all, of your gains in 3 years, right? In that one decision that you make.
Right. You said country A invading country B. As long as country A is not China and country B is not Taiwan, I think maybe it's not 20%. If that's the case, it's probably 100%. I don't know. Anyways, no, those are great points there, right? So, but let me ask you, when it comes to investing, whether it's passive or active, again, I'm going to take the role, the engineer, out of the mix here for a second. In your experience, what are some personality traits? Because the way I see Dr. Link is it depends on what the personality of that individual is, what their risk tolerance levels are, and their interest in the general stock market. Because I have friends who I don't know if anyone could ever convince them to become active traders or investors. They've almost always done passive investing, whether it's ETFs, whether it's one kind of fund versus another one. I just don't know how, like, if I were such a person, hypothetically, as a financial advisor, right, as a founder of Fireweed Capital, what would you say to convince me and people like me wearing the hypothetical hat here, where I'm like, you know what, Dr. Link, I'm more at ease and more at peace with investing in index funds and letting the market play out, as opposed to me making independent decisions about should I be investing in Nvidia versus CoreWeave versus Sweet Green or Shake Shack, for instance, right? What would be some things that you might say that would convince this person who's otherwise not so sure?
Yeah. So I'll give you probably the least satisfying answer, which is I'm not here to convince that person that active investing is what they should be doing. And there's actually a much deeper reason for that. At the end of the day, I believe that the financial resources you have should be supporting your goals and your life. And my job, really, as a financial planner, is to help you achieve those goals. Now, my personal philosophy is I think active management is the better way to achieve those goals in a safer manner. But ultimately, what I need to do as a fiduciary is I represent my client's best interests, right? And so even beyond that, I represent my client's interests over my own, right? And so if you're going to sit down with me and say, look, here's the goals I want to reach, here's the money I have, and I don't really like active management, I will run a plan and we will look at the numbers. And if this passive investing gets you there and we agree that we're not going to sell when the market goes down, I think we're going to, hopefully achieve the goals that you want, right? How we get there, my personal philosophy, my personal view is we should be using active management for that. Most, if not all of my clients that I have their money in our actively managed strategies, right? So they agree with me on that. You're dead set against active management. My job isn't necessarily to convince you that it's the right way to get to
No,
your goals.
makes sense, right? And then the people who are doing it actively, can you help us understand more specifically as to what level of engagement you tend to have with them? Are we talking active on a weekly basis, on a monthly basis? Like, how does that interaction work? Let's say someone has $100,000 and they're like, "Hey, Dr. Link, I need you to help me plan my future with this portfolio." How do you go about doing that, and what is the frequency of those interactions, and what are the types? How does a conversation typically go about?
Yeah. So we do what's called discretionary authority. And basically what that means, we'll take a step back. There's a couple terms in finance that are important. The first one is fiduciary. That basically means that by law, I am obligated to put my client's interests ahead of mine. And specifically called out in that is the fact that I put their interests above my revenue, my income. And so if I'm going to make more money by suggesting that we do active management instead of passive management, making that suggestion on the basis of me making more money would be unethical for me. And so as a fiduciary, that's really truly I'm working my client's best interest. The second one there is discretionary versus non-discretionary authority. And all of my clients provide me what's called discretionary trading authority. So when you invest with us, we basically manage your money, and we are taking the role of the active money manager, and we are doing the trades on your behalf. So what that means is you get to sit back and check in once a quarter with us and say, how are we doing? What's new in my life? What's new in your life? What's changed? Are our goals still the same? Are we still going the same direction? But really what that means is on a day-to-day basis, the trades that we would be executing on your account, we're doing for you, right? So it's not like you're taking time out of meetings and having to go run and do trading on your phone or something.
Okay, I got that. So let me see. Let's say I have $100,000 here, right? So is it more like investing? When you go to the when I go to the ownership of any security, like when I go to Tip Ranks or one of those places, it tells me that it's 40% retail investors, 20% institutional investors, and then mutual funds and whatnot. So would you, as a financial person here in this engagement, come under the category of, like, say, an investment manager or a mutual fund manager? Would that be one of those categories?
Yeah, we would fall under institutional at that point.
Oh, institutional. Okay. In which case, let's say I gave you $100,000 and somebody else gave you $100,000. You manage that money, but you would not be executing trades in our accounts, right? In other words, we give you the money and then you make the best decisions for that money, whatever those best decisions happen to be. And then at the end of the quarter, you come and tell, hey, Krish, you did 4% or plus 8% this quarter. And this is kind of what the investments were, right? But on a regular basis, if you bought something this morning or sold something the next afternoon, that's not information that's necessarily privy to us as investors here, correct?
Exactly. Yeah. So what we use is what's called a custodian. And so basically what we do, and this is especially in the world post Bernie Madoff, is we don't take control of your money, right? We don't take what's called custody of your money. So you actually give your money to a third party, our custodian. Most custodians, so things like Charles Schwab is a very large custodian. Fidelity is a very large custodian. We use a company called Axos. They're also a very large custodian. And basically, so you deposit your money with them, and then you give us authority to trade in your account at the custodian. So we're executing trades at the custodian in your account on your behalf. And so what that means is all the reporting, how have you done? What were the trades? What are you up? What are you down? All that information is kept by the custodian. So we have access to it, you have access to it, but it's not like you have no information, right? So you can pull every single trade that we've done, and we don't have to provide that to you, right? The custodian can provide that without our involvement. And what that guards against is what Bernie Madoff was doing, which was basically making up trades. And so now, since we have custodians in the industry, you can't do that anymore. It's much easier to see what the advisor is actually doing to your money.
Oh, very interesting. And thank you so much for educating us. I am learning as I'm going here. I'm sure our audiences as well. So, in other words, you said the custodian provides that information to us, which means, let's say someone goes to work on Monday, they come back in the evening, something may have happened during the course of the day. Are they able to log in to that system and check what trades have been executed on their behalf, so to speak, that day?
Yeah, yep, you certainly can. And in fact, many of my clients do. But yeah, you get a username and password to log into the system to see what's happening. The only difference is, if you are used to something like a Charles Schwab self-directed
Yeah,
investment account, right?
correct. Yeah.
When you move to the custodian side, you don't see the ability to buy or sell. So what you would see is basically a read-only view. But you get the read-only view, and you get to see everything that happened in the account that day.
Wow, okay, so you do know that 1,000 shares of Nvidia had been purchased or had been sold, for instance, right? You get all of the information, you just don't act upon it because it's a read-only view.
Exactly.
That's good to know. So as we get deeper into this conversation, in terms of tools that you use, you said you have an engineering background, obviously. So when you're doing this today, like Dr. Link, what are some of the tools that you use to help yourself so you're able to execute on those trades and do better? And also, what are some of the tools and perhaps technologies that you use to help the clients better, your clients better? So if you can just speak to some of those tools, essentially, that'd be helpful.
Yeah. So I'll start with the tools for my clients. This is actually, I think, one of the things where Fireweed Capital really provides for engineering clients. But we basically make use of a number of fintech companies. So I kind of look at there's three main areas in financial planning that I want my clients to understand where their money is. And the first of that is kind of your budgeting. So day to day, where is my money coming from? Where is my money going to? So we use an app called Monarch Money for that. Most folks, if you're in fintech, might be aware of Monarch. It is a retail application. You can download it on your phone. We basically have an advisor subscription, so we pay for Monarch for all of our clients. And what that gives us access to then is we get to see kind of where your money's coming in and going, which allows us to then help advise you on, are you spending too much in this category versus, say you're eating out every day and we notice your restaurant budget's really high. And you also said, well, I want to send my kid to college. And we notice that there's no money going into your kid's college fund, right? What we can do is we can look at that and say, hey, have you considered maybe eating out less because you can send your kid to college then, right? And so that that helps clients there. Second thing we do is we use planning software. We use a planning platform called eMoney. There's also Right Capital out there, and then a number of retail-based applications as well. But basically, what this is a huge piece of software that we put a bunch of data into, and then we put your goals into it, and it gives us the percent probability that you're going to be able to achieve your goals. And behind the scenes, what it's doing is factoring in things like taxes, all the different income brackets, all the different rules for where your money goes, how you take it out, what returns could look like, a bunch of Monte Carlo simulations. So that's one that we use. Many other advisors use it as well, but I particularly like eMoney. And the last thing then is basically the custodian portal. So that's your ability to go in and see where your investments are and how your investments are doing on a daily basis. So that's kind of really the technology stack that we provide to our clients. And then, of course, email and phone, right? Because that's the easiest way to reach us. But that's basically what you get. So I like to think we're fairly tech forward in that manner. I will say, coming from a fintech myself, moving into the space, there's always ways that it could be better and easier. And I realize 3 logins is not the ideal user experience, but that's where we are today. In terms of yeah, go ahead.
No, sorry, go ahead.
In terms of what tech do we use? So behind the scenes, right? What are we looking at? A whole bunch of market data APIs. And this is where you have to choose the area in which you're going to play in the market very carefully. Because technology in stock trading or options trading or Forex trading quickly becomes a race to nanoseconds, right? And if you can get a consistent edge over another trader, you can take profits. There was actually a story that I read in, I think it was the Wall Street Journal, about a firm, high frequency trading firm, that sends a half a packet. So like the header information goes first over the wire, and then they run the algo and determine if they want to finish the packet. And if they want to finish the packet and complete that trade, they send the rest of the packet. If they realize they don't, they send garbled data. But what that garbled data does is keep the connection alive to the server, right? So then the next packet they send the header, and then they decide if they want to do that trade, right? Like that's the level of speed at which you need to compete if you're
Wow,
going
that's
to do like
amazing. That's
Forex
a very
trading.
specific and a very interesting example. Thank you for sharing that actually. Yep. So in other words, you know, okay, that very nice set of points you mentioned. That follow-up questions I have for you there.
Mhm.
What are you mentioned multi logins, right? Let's say it's not single sign-on, but let's just forget that for a moment. As I'm asking this very specifically as well on a recorded call, actually, because I mentioned to you that we were starting to work on the fintech API, right? And maybe I'll hit you up offline to talk a bit more about that. Uh, as we use these tools as investors, right? Somebody who's been actively trying to trade the last few months, to be honest with you, Dr. Link, I've been doing that because I have an interest in finance, much like yourself, and I run an engineering company, so everything we look at has an engineering answer to it. Because if you're a restaurateur, you look at things like food. If you're a developer, you look at it like code or something like that, right? So
Mhm.
I've been using a number of tools, and I've been using some of those tools for a long time, actually, right? And the technology changes very quickly, right? Things change very, very quickly in general, but software engineering is a field where things always change quite fast. AI has just put that into 100x, 10x, or 100x mode where things are changing a whole lot quicker. That's the reality on one side of things, right? When you look at companies like Nvidia and look at all the peripheral companies where money is going through in a loop, a lot of stuff is happening there. But when I go to use these tools, and I have to believe these finance companies have a lot of money, right? There's surely no dearth of money. They're all multi-billion dollar companies. The tools have not really changed. And here is my opinion. Tell me what you think. Like I use Fidelity, I use E-Trade. It hasn't changed much at all over the years that I'm like, as somebody who sometimes, when I'm doing day trading, I'm like, this is not good enough, right? You're talking nanoseconds. I'm not even talking nanoseconds, right? I'm not even talking milliseconds. I'm just talking seconds, basically. I'll give you a simple example here. Let's say I placed a trade. Could feel like a digression, but I promise you it's not. I place a trade and I place a stop loss, right? Maybe it's a trailing stop or regular stop loss, doesn't matter. Right? Place a stop loss order. Now, when the stop loss did not hit, maybe things changed for the good or the bad, doesn't matter. I decide to close that position, right? I'm like, you know what, I'm done. I don't care. I want to get out of the exit that position. On all the tools I'm using more than one. I have to go actually have the cancel order page ready, cancel that order, and it takes actually not 1 second, it takes at least 2 seconds in a lot of the platforms before I can close the order because there's once I hit cancel and go to the next tab and close, it says, you know what, you have an open you have an open order, but I actually don't because I canceled it. So long story short, this experience has been quite the same for years basically. And to me, the basic requirement as a developer for me would be when I go to close a position, I want to override the fact that there's an open order because I am the human doing it and executing on that. Either know or recognize the fact that there is an open order, or if not, I want to have a checkbox that says, you know what, Krish, I'll cancel the open order and close this position at this point of time. But no, none of these tools support that, right? I've just taken a very specific example. I can give you 100 examples like this, which is why we are actually working on this fintech API, to be honest with you. So have you seen these tools keep up with what's happening, or do you agree that it is actually quite dated?
It is very dated. There's a couple of very complex engineering problems underpinning any sort of trading or exchange system. If you want a really good technical read, I think it is Vanguard, I think is who it was that was talking about this. I may get the broker wrong here, but basically they talk about how they take their central order book. And so inside of every stock brokerage house, they basically have this thing called an order book. And what that does is it takes people who want to buy and the people who want to sell and it matches them, right? And when it matches them, then it clears a trade, writes that to their trading ledger. What's difficult about this is you can't run a active order book. That's just something that like it's just very very difficult to do. And so essentially you end up running a singleton of an order book. Like I said, I think it's Vanguard. What they do is they actually pass their order book around the world. And so when you think of a 24/7 market, what they're doing is like for a certain period of time, New York has the order book. And then at a certain point in time, New York passes their order book to Japan. And then Japan has the order book for a while. And then they pass it over to London, and London has the order book for a while. And so what they're actually doing is they're passing an order book around the world. And so your latency then changes depending on where you are as a trader, depending on where that order book is. But what they end up doing on the back end is any trades that don't execute, at the best price or that breach some sort of, settlement agreement that they've got written in a contract, they go into the back end and they just change the accounting for what happened for that trade, right? And they just kind of settle up then right after the fact. So it's actually a very complex engineering challenge to make an API that works when underlying everything is a singleton. And so that's why, you say, yeah, I'm going to go ahead and cancel this order. Well, there's a whole bunch of orders that are stored in one system, and now you're trying to cancel it, right? And so that takes time to go in and see where those orders are, actually cancel that order, make sure that cancellation flows all the way through, right? And that's just the order book for one particular company, right? So if they've actually gone and now submitted that order outside of their company and they're trying to settle that on, like the New York Stock Exchange in their book, now you have to transit out of your company's book into the New York Stock Exchange book and cancel that, right? So like there's a whole bunch of layers until you actually get to the system of record, and that system of record may not be who you think it is.
Sounds very simple. No, I'm kidding. Oh my goodness, I'm not surprised because I mean, the U.S. stock market. I could be wrong here. I think it's like 1/4 of the stock market. It's 25% of the stock markets globally, right, or something along those lines. And Nvidia alone, as a company, I think is larger than I think every other exchange there in the every other stock market in the world except China and Germany and India or something like that, right? So we are massive, massive stock market. So I'm not surprised there's all of this complexity there, right? This is amazing what you've shared. I know we got like 7 or 8 minutes, and I want to switch gears quickly to something else, but related to this.
All right.
The exchange right now is like 6.5 hours of day, right? At least it's open. The active trading time is 9:30 to 4 p.m. Eastern time, 5 days a week. I'm sure you know that it's going to change rather quickly, where it's going to become, I think, 24/7, and they're calling it 9:30 to 4 is still the active exchange, but then it continues from 4 to right now it's 4 to 8 p.m. But it's going to extend. They're going to make it the 3-part day or something along those lines. Yada yada yada. But you're going to have the exchange open like 24/7. Maybe the volume of trades may not be the same across those 3 segments within the day. It'll still be probably a lot more voluminous during the core part of the day, but it's going to be 24/7, 5 days a week. And I read somewhere that eventually it could actually become 24/7, even 7 days a week, possibly, right? But initially it's 5 days a week because there's a lot of interest in wanting to invest in the US stock market by folks who don't happen to live in our country. Just keep that in mind. My question is, I'm going to tell you a couple of more things and I want to get your thoughts on it. Is with AI, changing just about everything, all of it, any of us is doing. Next year is going to be just as interesting, if not more, than 2025 was in terms of engineering needs, layoffs, and corporate America and whatnot. Right? People say that developers are going to be replaced by AI, but someone told me the other day, before developers can be replaced by AI, developers can use AI to replace almost every other role in the team, right? Which is a funny way of looking at it because that is sort of true as well. Which means there might be more people out there looking for work. I don't know, next year, maybe the year after. The AI is going to do, I don't know, I read somewhere like 80% of what all humans can do. So assuming that there are more people available to do something, Dr. Link, do you expect 24/7 markets, 5 days a week, maybe becoming 7 days a week, and more people probably exiting the workforce either voluntarily or involuntarily because AI is able to do what they do better than what they are doing, how they're doing it? Do you see more people enter the market? Do you see more activity? Are you excited about what's happening in that sense, meaning more people are going to come to you for help? And what is your take on this?
Yeah, great question. And I think we actually have a really good recent event. If you remember COVID, and you look at trading activity in the markets before COVID and after COVID when it comes to retail investors. Retail investors basically piled into the markets during COVID. People were bored, they had nothing to do, Robinhood took off, and everyone started trading stocks. Like really in the last 5 years, trading stocks, trading options has become something that many people know about and are able to have at least a cocktail conversation on. right? Prior to that, many people didn't understand what even equity was, what owning a stock meant. So I certainly think that as folks, if they are getting laid off, they have free time on their hands, I think that they're going to go to the markets. But I think they're going to go to the markets actually for what is likely to be the wrong reason. And this is where I'm hoping financial advisors can step in and we can help avoid some of the catastrophe that might happen. And basically, what folks are going to go to the markets for is income replacement and excitement. So the first thing is, now that I don't have a job, I need money. So if I can trade stocks, I can do day trading, I can make $1,000 a day times 30 days, right? I can, replace my old salary. We're going to be pretty good here, right? My family can survive. And the first thing is $1,000 a day day trading is really difficult because it's not $1,000 a day. It's $10,000 on Monday, and you lose $9,000 on Tuesday, and then you gain 1,000, right?
Absolutely.
And it's, there's an old joke. What do you call a trader who's right 51% of the time? The answer is a billionaire, right? But you got to be wrong 49% of the time, right? And that takes a very strong constitution, very strong stomach for losses. So I think you're going to have folks that are there to make money, but they're also there to be entertained. And we did see this with Robinhood, where folks were trading and they go on Reddit and they get stock trading ideas, and it's a social thing, right? Everyone's there trying to beat the market, beat the man, and all that. So it's entertainment. But what I would say to folks who might find themselves in that position, and I will say this is the closest I'm going to get to financial advice. Don't go into the markets for entertainment with the money that you need for retirement, right? Much the same way you don't take your kid's college fund into Vegas and go gamble on the hopes that they're going to get a higher college fund, right? Don't go into the market with $1 million and expect to turn it into 2 million by day trading. You will not. You will lose most of your money, right? So if you're going to use it for entertainment, set a limit. If you're up, great, but treat it the same way you would go into Vegas and have a pool of money that you say, this is my retirement, or this is the income for my family. I am not touching that, and really stick to that.
Amazing. I think it's, you made some great points there. I probably pick up on some of that when I do the solo, I do solo podcasts as well. We mostly do engineering, but off late we've been doing some finance stuff simply because we're starting to work on that space. But this is amazing. Everything you've shared here, Dr. Link, has been phenomenal. So thank you so much, right? So I know we have a minute or two. Do you have any questions for me before we end this call?
That's a great question. I would say so as a CTO, as a fellow engineer here, uh, give me your thought on where do you think the market's going to go here in the next couple of years. I'd be interested in hearing a fellow engineer's thoughts.
Yeah, absolutely. I'm going to have this financial disclaimer at the bottom saying this is Krish's opinion, right? Perfectly. Please do not believe it. It's for entertainment purposes only, right? It's a very interesting question. I'm going to take like probably 2 minutes to answer that. If that's all right. As we end this year and we look forward to the next year, I was reading something the other day. Let me say a couple of things. Brevity is not my forte. I'm going to say four different things and hopefully collectively they make some sense. One is, people tend to look at analyst ratings, whether it's different platforms that you're using. Someone says, hey, buy this. Citibank or Bank of America says it's going to be like $300, $400 in the next 6 months. Years ago, I would look at those numbers and say, you know what, that's amazing. I never do anything. Because these are people who are experts in the industry. They say it's going to be like $400 next year, which is like 37% more than it is right now. I have to do nothing. And then as you get older, you recognize that if it were that simple, why does anyone even go to work? Right? Why do you have to read some stuff and have any of this experience? And then they recognize that the analyst ratings are tend to bound to change every day or every other day. They say it's $400 one day, and next day you wake up, they're like, oh, you know what? We've cut our ratings down. It's 325 now. I'm like, oh my God, you didn't tell me yesterday, right? So those are things you learn thinking, you know what, no matter what you read, you've got to make your own decisions, for instance. And two, I go to a lot of these conferences with a team member of mine, Dr. Link, where we understand the market because, we are in the space of building software to solve real problems, right? So we also need to understand by going to these conferences. So we've gone to a lot of these finance related conferences recently this year. And I've heard hundreds of Fortune 500 CEOs speak like 5 foot from where we were sitting down. You know what I mean? So hearing it from the horse's mouth. And it's been immense learning. I'm going to share a couple of things here, which is about 6 to 8 months ago when I went to the same conferences where they brought these CEOs and asked them about AI and investments and CapEx. They had good answers, but they could not answer to what the return on investments looked like about a year ago, right? They were like, hey, we're expecting some good ROI, but we don't exactly know what it is like. Fast forward 12 months, 10 to 12 months, some of those people, the same people, actually had numbers saying, hey, you know what, AI reduced our capex or increased our capex so much, but we were able to cut costs here or change this functionality or make do things better. So numbers became more specific that told me that maybe things are actually happening. And then I had a conversation with the CEO of a data center who gave me numbers of the energy needs of these data centers, right? And then, 1 gigawatt data center requires about the same energy as 1 million single family homes in the US, right? I mean, this is like big numbers. And then you wonder, okay, you know what, maybe you have to invest in the energy sector because there needs to be a lot of energy. There needs water needs for data centers, but then there are farmers protesting in Atlanta. There's a lot of things happening, right? Some people are excited, some not so much, all for good reasons. And then you have news about, is a market crash coming? It's 3 years, S&P's been high, and some bunch of analysts saying next year is going to be great too. And then on one side, people are worried. You had Michael Burry, if I'm getting the name
Hmm.
right, who had shorted
Yep.
up for some time at least Palantir and Nvidia, and people are going crazy. Looks like a very sane person. He looks very calm and composed, so I wouldn't want to dismiss what he says. Given all of this, long story short, it tells me that no matter how much reading one does, no matter how much you trust this platform versus this analyst versus that analyst, the beauty of trading and investing, Dr. Link, I don't know if you agree, comes down to your own needs, right? What is your family situation? What are your needs this year, next year, the next many years? How much risk are you willing to take? I mean, I have friends who wouldn't take 1/100th of the risk that I would be generally willing to take. You know what I mean? So they have to have a different investment pattern than I should do. If the two of us subscribe to the same Seeking Alpha or Bar Chart or something, these are all great tools and platforms, right? But the article is not personalized to Krish versus somebody else, right? It's the same article. What we take away from those articles needs to be customized and personalized to where we need to be. Maybe AI will hopefully do that in the coming year or years to come, but we're not there yet today. So to me, there could be a market crash. There could be these energy needs. Zuckerberg is building data centers the size of Manhattan as we speak here, right? So I don't know what the right answer is, but where I stand is I love these tech CEOs. In being in that business, you sort of want to trust them. If Jensen Huang says something, I'm like, you know what, it's got to be right. Everyone is wrong. Jensen Huang is right, right? So if you belong to that school of thought, I want to go with AI is here, lock, stock, and barrel. There's a lot of money being spent. People were questioning the Alphabet CEO Sundar Pichai, and he had said in a conference call 4 quarters ago, the risk of over investing in AI is less than the risk of non-investing in AI. And Alphabet has gone up 60% in the last 3 months or something like that, right? So I think I've seen people belong to two different schools of thought. One that are very skeptical about AI, developers, engineers, people who are building that saying this thing is going to come crashing down, right? And there's this other school of thought where people are like, nope, this is just the early stages. Things are keep going to go up from here. So I think, like you said, I think you said it best, right? You can only put so much money in the market that you're willing to. I'm paraphrasing what you said, but that you're willing to either lose or not need in the near term, for instance, right? Or as Warren Buffett, I think, said, if you're not willing to see your portfolio drop by 50%, then you should probably not even be in the stock market, for instance, right? So at least those would be my thoughts. Hopefully, some of them made some sense there. But I had one last question for you, which is non-technical, right? What is your favorite food?
What is my favorite food? That's a really good question. So I live in a small town in northern Minnesota, and I tend to have frozen lunches a lot. And I've actually been really partial to a chicken tikka masala frozen lunches. I have a lot of Indian food. It's a really good frozen lunch. And when I go to the local Target, I basically buy out the frozen Indian lunch section. So they've slowly started adding more options there. So there you go. I'm a real sucker for Indian food. For anyone who actually does live in India, I know they're saying, well, frozen Indian food isn't Indian food. I know I've been to Bangalore. I've had actual good Indian food as well, but there's just something, it's a great lunch. So there's
Wow,
my answer.
that's good to know. What I will say is, I saw a comedy sketch the other day where this American guy goes to India and he's going to place an order. Someone says, maybe you should just get him butter chicken or one of those things. And then the other guy goes, oh my God, don't be so judgmental. You know what? He might get something else. Let him actually place the order. And then there's a lot of chaos around it. The other one, this one of them says, get him butter chicken with naan and butter naan and whatever, right? And then finally, they gave this guy an opportunity because one of them fought through and said, you know what, he has to make the decision. You're being so presumptuous about what he might need because he probably is going to order something else. And then after a lot of chaos, they asked this guy, what do you want for dinner? He goes, butter chicken. I still, it was really funny. I think there's a guy in the Middle East who actually does go to India and does create all of these reels and stuff. It's quite funny. His name was Almet Kalmeri or something like that. But it's awesome. Thank you so much. Really appreciate your time and plentiful learning, not just for me, for everybody watching this, because we talk mostly engineering. Talking finance is just as important, if not more sometimes. So, folks, again, this is Dr. Adam Link, who's the founder of Fireweed Capital. You heard it from the horse's mouth. We know how much, Dr. Link, you actually know about the subject. So, people want to reach out. I'll add, I'll include a link to your homepage and a LinkedIn profile. If you could just share that with me, then I can just stick that in the podcast, or any other links that you want for us to include. Happy to do that as well. Thank you so much. Much appreciated your time.
Perfect. Thank you so much. It's been a pleasure. Have a great one.
Thanks.